Alrighty, last session before afternoon tea, and then we're on to the rest of the day and to the closing drinks, which I'm sure you're all looking forward to. So this next panel is how to be a financial crime fighting superhero in your fintech. Funnily enough, I work for a fintech called Superhero, so I'm very, very interested in this one. And on the panel, we have Andrew Davies, the Global Head of Regulatory Affairs for Comply Advantage, Vaughan Shanks, the co-founder and CEO of Sidam. I hope I said that okay. We have Michael Bridgman, the co-founder of Dataco Technologies, and moderating the panel, we have Vanessa Block from Allens. Welcome.
Thanks very much. Hi, everyone. Nice to see you. So we're talking about financial crime today, and I think for the purposes of this discussion, we're going to take a pretty look at it in terms of a pretty broad concept, but might start by asking Andrew, what does financial crime mean to you in this context?
Well, the first thing it means to me in this context, and specifically in the context of this event, is how inspiring it is to have you people here listening to a session about financial crime, right? So if you think about, and I am an abject failure in fighting financial crime. Now, the reason for that is I started in this business. As you can see, I'm pretty old compared to all my other panelists here. So I've been in this industry since the mid-90s. I'm originally from London, but I live and work in New York City. And I've been working with some of the largest financial institutions, lots of fintechs, on how to use data and technology to manage financial crime. So if you think about way back in the mists of time when the organizations started tracking these things, the United Nations about 25 years ago estimated that the amount of money that's laundered through the global financial system is 2 to 5% of global GDP. What they estimate today is 2 to 5% of global GDP. That's $1.6 to $3.6 trillion laundered through the financial system. So that's why it's sort of inspiring to have you sort of sitting on this session. There's been many sessions today that have talked about AML and KYC almost as a throwaway comment. What the regulators are focused on now, to the point around what is financial crime, are many of the predicate crimes for money laundering. So if you think about human trafficking, you think about drug trafficking, and by the way, at this point in time, every day of the year, there's around 50 million people subject to human slavery in the world. So we talked about this in the preparation for this session. It's 2023, 50 million people in human slavery, leading to around $130 billion in annual revenues being processed through the global financial system. That's a shocking statistic, but that's an example of financial crime, beyond fraud, beyond money laundering, beyond terrorist financing. That actually equates to around 49,000 people in Australia being subject to human slavery. Seems like something that should happen somewhere else, right? But it's happening in our daily lives. And the proceeds of that criminal activity gets laundered through the financial system. There's a definition, I think there's 13 taxonomies from the FATF, the Financial Action Task Force on Money Laundering, that talks about the different types of financial crime. And then there's a great resource, and I can direct you to it if anyone wants this, but there's a definition in AMLD6, which is the European Union legislation on money laundering, and that defines the 22 predicate crimes for money laundering, which constitute that complete landscape of financial crime.
And so, you know, there's been a lot that's been said, I think, especially in the last week or so, by ASIC and APRA have come out with their corporate plans who've really emphasised the impact that scams are having on the community at large and on the financial services sector. Obviously, cyber is a key component of that as well. Vaughan, can you talk a bit about the cyber angle to financial crime and how that's playing in?
So cyber risk really is, it comes down to three things. So it's the confidentiality of information, it's the integrity of that information, and the availability of the services. And so I would class, financial crime has a cyber angle on it is anything that would be compromising the confidentiality, integrity, and availability of financial services. And it is, as with other types of financial crime, money laundering, fraud, it is a global problem. It is in fact growing year on year, as opposed to staying the same size as we bring more and more systems online and the complexity increases. And it's also, I guess the other part of it is it's increasingly subject to regulation in every jurisdiction. So that's another thing to keep in mind.
And Michael, why are we seeing increased risks in financial crime? Why is it biting across the community and the financial services sector so much nowadays?
Yeah, I think Andrew's touched on it. There's a huge amount of money to be made off the back of financial crime. And I think, for those in the room in the fintech space, that puts you guys sort of right at the center of that potentially. There's a number of vectors that you're directly sort of responsible for. You hold sensitive data, you're trying to build and scale a business and everything, all the risks that come around that in, engaging offshore workforces, a number of vendors that you need to be aware of their processes and practices as well. And then there's just the nature of your businesses that you're trying to create. You're trying to remove friction from the system. And a lot of that actually from the incumbents is designed to keep their consumers and their data safe. So a broad area.
Yeah, I actually have some comments on that, because if you think about, there was a proliferation of criminal activity and scams during the pandemic, right? And Australia actually had a pretty prompt reaction to informing people about these scams. But generally, financial crime is counter-cyclical with the economy. So as people are under more pressure, they become more vulnerable. I think that's one of the ideas sort of in support of what Michael was saying. And certainly, as Vaughan mentioned, there's increase in legislation. So if you look at one of the most highly regulated markets in the world is the United States. So if you look at cyber, in particular, look at the legislation from the NYDFS, so the Department of Financial Services in New York State. They have good guidance on cyber. But that idea that financial crime is counter-cyclical with the economy is super important to bear in mind.
And just looking at the way this then bites on fintechs, obviously they can be a direct target of some of this activity. But then they also typically form part of the supply chain for the big financial services clients that are highly regulated. Vaughan, what are you seeing? Because you often see this from the big end of town and the sorts of controls they're putting in place. What should fintechs be expecting when they are forming part of that supply chain to deal with some of these issues?
Yeah, so really there's a couple of angles on this, and one is the direct threat. So, are you going to be a victim of financial crime directly? And cybersecurity as a discipline borrows a lot of its terminology actually from national security and, from warfighting. And so when we think about threats, we think about a threat as being a capability combined with an intent. So I think it's a well-known fact that Australia has people employed by the government who are well capable of conducting a cyber attack, a devastating cyber attack, and they do so with quite frequent regularity, but you often won't even read about it. They are not going to be attacking your fintech anytime soon because they simply don't have the intent. However, if we're talking about criminal gangs, whether they be out of Russia or China, or actually, in fact, the nation state of the Democratic People's Republic of Korea, or North Korea, North Korea employs 6,800 people to do cyber attacks against companies just like yours, because they need to fund basically a rogue state, and they can raise $1 billion a year by stealing from financial services. And of that, I'm told about 30% is routed to their nuclear weapons program. So by being vulnerable to cybercrime, you're actually helping to fund nuclear weapons by North Korea, which is not a nice thought. But so thinking a bit more about the capability and the intent, really what it comes down to is how do you basically arm yourself against this risk? How do you take countermeasures so those capabilities can't be leveraged? The other angle on this is compliance. So we've spoken about the risk. Compliance is the other side of it. So in order to do business with the larger organisations, your clients who could be large banks or other financial services companies, you need to meet their standards for security. And they're often, if you're not directly under the scrutiny of the regulator, you can be sure they are, and they'll be requiring you to conform to the very same standards they are. And this includes notification times. It includes, being able to fill out, a huge spreadsheet describing all the security controls you've met. And so really it's a matter of balancing this compliance and risk. And ideally, these two vectors are parallel. So if you're doing compliance well, you're also covering off against your risk, and vice versa. Where we get into problems is where sometimes your compliance requirements can actually go against your risk compliance, and that's where you need to think a bit deeper and maybe even have more than one solution in place.
So Michael, two-pronged question for you. Firstly, for fintechs that might be a bit more cost conscious and don't have the enormous resources that some of the bigger financial institutions might have, how much of their effort and resources should be applied to technically managing these risks through technical measures and controls versus governance and compliance frameworks and measures? And secondly, what is the area, or what are the areas where you find fintechs fall short, typically?
Cool, okay, so maybe on the first one, I think a meaningful part of your effort and investment should be focused on this area. And I would say the way to think about this is that you can absolutely leverage governance and compliance as an accelerator in your go-to-market. So we are an early stage business ourselves. We've just gone through our ISO 27001 and SOC 2 certification, and while it's an arduous task, there's a number of amazing sort of RegTech or RegTech vendors in this space that can support with those processes. So while the work is intensive, they've digitised and streamlined a lot of those processes, and really as a young business, what that helps you do is embed governance and compliance as a part of your daily operations. And obviously Andrew can tell you all about Compliant Vantage after the session and how they help with the monitoring and tracking and identification of that risk. And sorry, what was the second part of that question?
Where do fintechs typically fall down?
Yeah, I think it's trying to balance that speed to market, the reduction of friction in your product with the fact that compliance is a heavy and arduous task. And there's limited resources that you have as a young business trying to grow. And so it is just that discipline around, no, we have to do this, we have to do it early. And it's far easier to be proactive and embed it, as I said, as a part of your organisational rhythm than it is to try and band-aid and fix breaches or whatever the issue is down the track.
And it's also easier to do it when your business is relatively smaller,
Absolutely.
so you're not having to retrofit that after the fact. Andrew, what are your thoughts on how best to create that balance between managing those risks but also creating that seamless experience, which is so often the proposition for fintechs that are trying to get into the market and sort of eat away some of the market share from some of the bigger institutions?
So I just had some comments, I think, on what Michael had said in particular. So you have to have security and integrity synonymous with your brand if you're a fintech, right? So we should celebrate the sort of almost the Cambrian explosion of innovation that we see at this event, right? So that the advent of more egalitarian payment infrastructures, the advent of new digital assets. So there was a session earlier on where we were talking about scams related to digital assets, and crypto in particular gets a bad press. There's around $20 billion, this is a statistic from Chainalysis, $20 billion of illicit transactions flowing through the crypto exchanges. That's tiny compared to traditional financial institutions, the amount of money that's laundered, right? We're talking about $3.6 trillion. So I think you want to make sure that security and integrity is synonymous with your brand. And to the specific question, the place you should start, and this has been a sort of mantra in the, particularly in the AML world and the financial crime risk world for the longest time, you have to do a risk assessment. So that's, you have to balance your innovation, because any organization, notwithstanding any internal nefarious activity, can stop fraud, they can stop money laundering by looking at every transaction and every event. The problem is you won't exist as a business very long if you're doing that, because we talked about enhancing the customer experience, you know, over the last couple of days, straight through processing of transactions. Obviously we want to support that, but we want to manage risk effectively. So to Michael's point, you have to do a risk assessment. That's the first place to start. Now that has to come from a tone from the top. Right, you don't want to be in an organisation where the CEO is off talking about, you know, not really caring or not really paying attention to risk. But as Michael said, you want to make sure that that's manifested as soon as you start, and make sure you engender that sort of culture of compliance and culture of risk management. That's the right place to start. And then also, you have to use technology at this point because you want to scale as a business and you don't want to employ an army of people remediating notifications that there's some suspicious activity. So you've got to start using technology and using data. And the fascinating thing about the, particularly the FinTech industry is you have people that are better at analyzing data, and you have access to more data than you've ever had before. So start with a risk assessment driven by a tone from the top, and then start to use data and technology to effectively automate the management of financial crime risk. That's what I'd say is a sort of starting point.
And those risk assessments are becoming increasingly important, aren't they? Because the regulators are absolutely demanding it. I think we're seeing across APRA-regulated institutions, there's CPS 230, which is going to be introduced. We've got a final version now, and that's quite prescriptive around the sorts of risk assessments that need to be undertaken, and that's going to then filter through to fintechs as well. Vaughan, you be seeing that in a cyber context as well?
Yeah, very much. This month it's quite topical actually, because the Department of Home Affairs Critical Infrastructure Centre have been telling everybody that in fact, I think it was either earlier this week or last week, was the end of the honeymoon period for the Critical Infrastructure Risk Management Program. So if you are critical infrastructure and financial services falls under one of the 11 critical infrastructure verticals, then you need to be having a risk management program that's I think it's tested twice a year, and you've got to have like quarterly or half-yearly reports stating how you're stress testing or updating your risk management plan. Whether you're you have incident response plans in place, like all of that, and a lot of it is aimed at basically if the payment system goes offline for a day, nobody eats, right? So it's right up there with with electricity and water.
So just to go back to that monitoring and reporting point, and Andrew, that there's, as you say, there's a lot more technology that allows you to do that now, and I think there's, again, greater expectation from regulators that reporting is going to be coming up through to senior management and also the board, who are going to be involved in setting tolerance levels for disruption, all of that kind of thing. And again, expectations around ensuring that there's adequate management of the supply chain, and so the reporting has to go the whole way through. How do you think about taking the technical monitoring and reporting data, for which there will be a lot of it, especially over time, and turning that into something that's actually going to be usable for senior management, for a board, for customers?
Yeah, so this is a fascinating subject, and I think this is a bit of an inflection point in the industry where regulators on a global basis, including Austrac, are talking about how they can collaborate more effectively with the participants in the financial services ecosystem to actually share data. In jurisdictions like the United States, there's actually a section of the USA Patriot Act, or the Bank Secrecy Act, Section 314B, which facilitates the sharing of this type of reporting data. But the interesting thing is, as you've got some sort of, let's say you're using machine learning. One of the things we do at Comply is we use machine learning to prioritize alerts that are presented to investigators. Well, you want to make sure that inference that you're making on that data is actually explainable and readable, so that senior executives can decide whether they're going to file something with the regulators. So we have to make sure that we're managing that data effectively. We can guarantee the integrity and the veracity of that data, and then the inference that we make on that data needs to use machine learning techniques that are explainable. Helps the analysts as well. They can understand why they're getting an alert rather than just having some black box score, which you do get in this space for something like credit card fraud. So we need to make it explainable, and then when we submit things to the regulators, we need to make sure that we can explain why we're submitting a report through that senior management channel. The other thing that is sort of useful, and you saw this with the FinCEN leak and the Panama Papers, is how can we draw information together across all the participants to share the inference that we're making to identify red flags across those multiple dimensions of financial crime. So I think that's super important. And I do like Vaughan's point about the integrity of the whole system. If you think about now with the introduction of something like the SWIFT GPI, right, you can send money from your Commonwealth bank account here in Australia to a bank account in Barclays in the UK, and I think that can be settled and subject to finality within 3 seconds. Now, if I'm sending money to the UK and it's say $10,000 and I lose that and it's subject to fraud, then that's pretty unfortunate for me. I'm pretty grumpy about it. But if you think about Macquarie Bank acquiring, like they did years ago when they acquired the M6 toll road in England, that's costing them billions of dollars. Billions of dollars goes missing and then is hijacked by some governmental sponsored insurgency group, like North Korea. That money can move between jurisdictions almost quicker than you can say $1 billion. That money then has the impact of that loss of funds can have an impact on the global financial system and will affect all of us.
And Michael, are you seeing a shift in the granularity of reporting that's coming up both within organisations and then externally as well?
Yeah, I guess from where we sit in the market, to Andrew's point around governments and the banking sector trying to work across their organisations, we are a technology that sits in the broader privacy-enhancing tech space, and that's designed to enable collaboration of data sets that are joint across business boundaries. So we see a lot of efforts now in Europe. We've got an organisation called TMNL, so that's a collaboration between 6 of the large Dutch banks where they're analysing transaction data across that organisation. And the benefit there is you are able to infer activity that happens across multiple organisations. So a lot of exciting stuff happening there in the UK, the US as well. They've announced a new PETS prize, which is designed at targeting fin crime as well.
Just conscious of time, I might just check whether there are any questions.
Yeah, I particularly like the Austrac focus on transnational crime or organised crime. You think about it, it's worth, I think, annual revenues to organised criminal groups around $1.6 trillion. It's a focus of the US regulators, the FCA in the UK, the Monetary Authority. And of course, it's sort of symptomatic of the world that we live in. Right, we live in a sort of globalized world. Money moves more quickly, peer-to-peer payments over the blockchain. We need to address this as a sort of a global problem. So as I said at the start, I'm a failure, but I need to finish my career being a success. And I think that sharing of data and that collaboration is sort of key.
I think also that point about risk assessments being an ongoing exercise and not just a once-off set and forget. And I mean, we're certainly seeing organisations have a lot more trigger points for refreshing those, whether it's entering into a new market geographically or offering a new product or service or divestments, that all of those are starting to come into prompting a relook at the sort of level of risk. Any other questions? Final observations from the panel?
So my final comment is something that I actually stole from the opening plenary of the FATF in 2020. And it's just something, the single thing that you should take away from this session: stop money laundering, save lives. Stop money laundering, save lives. And thanks for attending the session. I appreciate it.
Just putting in a word for cybersecurity. As a fintech, you're a small target, right? You can use that to your advantage. I know a chief information security officer, that's a CISO, who had to roll out hardware authentication tokens to 30,000 people in his organization. That's a major project, right? For most fintechs, you can do that in an afternoon, right? You buy a bunch of YubiKeys, hand them out to your staff, get everybody using single sign-on. You can actually be a very hard target because you're building greenfields infrastructure across a very small team, and it's much easier to grow that way. The second thing I wanted to mention is, we've spoken a bit about the direct risk to you being attacked as an institution. There's also your customers being compromised and defrauded through identity theft and then having their money stolen. So this is not really something that I think a lot of organisations have paid a lot of direct attention to. But I know in the UK this is becoming a really big issue right now, and that's going to come here next. So I think balancing that need to be fast and easy and convenient to use, but also providing a user experience that's inherently secure so that your customers won't put a foot wrong and end up victims of cybercrime themselves.
And probably just returning to one of the points I made before, just thinking about compliance and governance as a key accelerator of your go-to-market. Heard a great session this morning around, fintechs partnering with large organisations, including the big incumbent banks. So it can absolutely enable you to move quickly with those big banks. Large organisations want to see externally verified and vetted certification that you are compliant and that governance is a core part of your business. And the more you have in your back pocket to prove that early, just enables a number of those conversations.
Thanks very much for your time.